Hi, this is Charlie giving you Wednesday's video. Hope you're very well. As always, if you like these videos, do give them a like and do subscribe. It makes it easier because it flashes up for you and notifies you of when our latest videos have been posted. Right, so today you're looking at this contrarian indicator, so to speak, and I'm bringing you back to 2017. The only reason I'm going back this far is because it was a trade that I took personally at this time in early 2017. There were technical reasons to take this trade, but euro dollar bottomed on the 3rd of January 2017 and then had a wonderful run up to around about 124, 125 area into what was that early of last year, into sort of March, April time of last year. But let's take us back here. So at this point, what was going on as far as the talking heads and the financial media were concerned? So if we now, I literally went on to social media and just Googled the other day euro parity, and this is what the financial news media were talking about at that point. We've got the Financial Times. Economists expect euro to fall to parity in 2017. That was written on the 30th of December, just 4 days before the euro dollar bottomed. So what a great call that was there from the Financial Times. Euro plunge triggers dollar parity. That was in December 2016. Euro plunge. Euro's going to go to parity with the dollar whether Le Pen wins or not. That was in Business Insider. So let's go to the next one. Bank of America sees euro parity by the end of 2015. That was a little bit earlier. I took so many screenshots, I had all sorts. Euro dollar parity likely in 2017. That was written again in the Financial Tribune at the end of December. Euro's free fall towards euro dollar parity continues. And that was earlier in 2015, and then but they never went to parity, just bear in mind. And then all around this late 2016 is where most of these articles I've got. SocGen, November 22nd 2016, get ready for euro dollar parity. Wall Street Journal, dollar parity with euro coming. That was in November 2016. Another one that was in 2015. But of course I've got more, but I thought this would probably be enough. Goldman Sachs believes dollar will catch up with the euro and the two currencies will be about equal by the end of next year, and that was in late 2016 as well. So we had all of those media sources and financial organizations all calling for parity at that point into the latter part of 2016, only for the euro dollar to bottom and then technically go up a lot more. So one thing, if you're going to use anything and as a contrarian indicator, the news outlets are brilliant for that. So if a market is having a great run in one direction or another, do start to look out for what are the news sources saying, because once you start seeing clusters of news are all saying the same thing, that's when you start to use it as a contrarian source. It's no different with gold. I was only talking about this earlier today with gold back from, if I take to a monthly chart, back in 2011, after this wonderful run up. So many sources at that time were super bullish on gold, looking for gold to go to $2,000 an ounce, $3,000 an ounce at that point. And of course, and then you had all of the gold kiosks opening up in shopping centers where they would exchange gold for cash and all that sort of stuff. And things got a bit frothy there on gold at that point. And so when things get a bit too one-sided, then start looking at it in the other way. It's a bit like with the cryptocurrencies back in late 2017, getting a bit too one-sided. And even to the extent where if we go to currently with the S&P, what's the news coming out on the S&P at the moment? It's not all super bullish. There's lots of bearishness on the S&P where people are calling the next down leg. So in fact, the S&P at the moment, that's actually as a contrarian indicator. It's called the wall of worry. If you've got a market which is going up, but a lot of the talking heads and the analysts and the likes are calling for that market to go down, like the S&P and the stock markets, then probably more likely it's going to go higher. Why is that? Because if there's pessimism as a market's going up, it means there's still cash on the sidelines waiting to come in, because the cash doesn't believe that it's going to carry on going. But bit by bit, as that market comes in, investors throw in the towel and think, I can't miss out any longer, and they start to invest as well. So therefore, that helps propel the market higher. If everyone was super bullish on the S&P right now, that's when you'd want to be a bit more cautious, because when everyone's super bullish, there's no more money to come into the market. That's the overall idea. Anyway, some food for thought there this week on using the media to your advantage, and at certain times when they're all saying a very similar thing, that's when you want to use that as a contrarian indicator. Hopefully that's of use to you. I'll see you on Friday for live trading.